Top 4 high debt to income ratio mortgage options coming up. Hey guys, I'm Adam Lesner, and my oxygen is getting borrowers approved for a mortgage when other lenders say that it's just not possible. Today we're covering in depth the 4 best options available if you have a high debt to income ratio and you're looking to get a mortgage. Be sure to subscribe and turn on notifications so you stay in the loop on all my best mortgage tips. So let's jump right into it. What is a high debt to income ratio mortgage?
A high debt to income ratio, or DTI ratio, is any mortgage scenario that exceeds 50% DTI. If your monthly liabilities on your credit, including the mortgage with taxes and insurance, are, let's say, $2,600 a month, and your monthly income is $5,000 a month. So you'll take $2,600 divided by 5,000 equals 0.52 or 52%. Conventional loans require you to be 50% or below debt to income ratio. So let's look at what options we have.
Can you get approved for a high debt to income ratio mortgage?
In short, yes, it's possible in many cases. Everyone's scenario is unique and different. Luckily, there are multiple ways of going about this. Keep in mind, most scenarios show the debt to income ratio is high because there are other income sources that aren't eligible, or because there are other household members that have income to contribute but don't have eligible credit, so they can't be added to the loan. But here are 4 loan options available to consider if you do have a high DTI: FHA mortgage, VA mortgage, CDFI mortgage, and an asset-based mortgage. So let's take a look at each option in depth.
First one, FHA loan.
An FHA loan is probably the most popular option to go with if you have a high DTI. This is because FHA loans have the most flexibility when it comes to credit score, good interest rates, and low down payment requirements. It's important to be aware of FHA county loan limits in your area, and I'll include a link in the description below so that you have access to everything that I'm covering, including the link to check your loan limits. You do not have to be a first-time home buyer to be eligible for FHA financing. Here are some of the requirements you can expect when getting an FHA loan. As high as 57% debt to income ratio, pending desktop underwriting findings. A home purchase with as low as 3.5% down payment, up to 80% loan to value ratio on a cash out refinance, as low as 500 credit score is allowed, and this is only allowed on primary residence. Keep in mind, even though FHA allows it, many lenders have internal overlays that have additional restrictions, which makes it important to work with a lender that doesn't have any overlays.
Next one, VA loan.
If you're an eligible veteran, a VA loan is definitely the option to consider. Also, thank you for your service to our country. A VA actually doesn't state their max DTI. We've seen approvals as high as 60% debt to income ratio. To go that high, it really just depends on the strength of the credit profile and the loan to value ratio. For some reason, many veterans think you can only use your VA loan benefit once, and that is not the case. You can use the VA loan as many times as you like, as long as you have an available entitlement. Here are some of the requirements you can expect when getting a VA loan. As low as 0% down payment on purchase with 580 plus credit. For cash out refinance, up to 100% loan to value ratio. Free and clear properties are not eligible for cash out refinance. Primary residence only. There's no second homes or investment properties allowed on a VA loan. There are also residual income requirements that need to be met on a VA loan that your lender will need to evaluate while you're in process.
Let's take a look at the CDFI loan option.
This one is a bit unique because there's actually no debt to income ratio calculated. The loan is approved based on credit and reserves. For that reason, individuals with unusual income or employment circumstances might find a CDFI loan to be a great solution to accomplish the homeownership goals. A CDFI loan is made by a community development financial institution, or CDFI. CDFIs are private financial institutions that are certified by the U.S. Department of Treasury to provide financial products and services to underserved markets and populations. CDFIs use their lending and investment activities to promote community development and economic growth in these underserved areas. Here's what you can keep in mind with the CDFI loan. Approval is based on credit and reserves, as low as 640 credit allowed on purchase and refinance, as low as 20% down on home purchase with 740 credit and 12 months reserves, up to 80% loan to value ratio on a debt consolidation refinance. Up to 70% loan to value ratio on a cash out refinance. Available on primary and second homes. Not available in all states. Important note, when doing a cash out refinance, the cash out proceeds can be used to cover the reserve requirement, which is huge.
Last one, asset-based mortgage.
Another alternative to high DTI mortgage. Here's another way to get approved based on assets and credit, not income. If you're able to show you have 125% of the outstanding mortgage balance and reserves, an asset-based mortgage may be the direction you want to consider. Example, let's say you're borrowing a mortgage of $150,000 and you have $187,500 in eligible liquid assets that you're not liquidating for the transaction. You meet the reserve requirement on an asset-based mortgage. Here's what you can expect on an asset-based mortgage. You can use up to 60% of retirement funds to cover the reserves if not at retirement age. So if you have $100K in your IRA, you can use $60K in the eligible reserve asset calculation. As low as 20% down payment on home purchase with 700 credit, up to 75% loan to value ratio on cash out refinance. This is not available on all states, but it is available on primary residence, second home, and investment property.
So when does a high debt to income ratio mortgage make sense?
As mentioned earlier, usually a loan is showing up high DTI because there are other income sources or other household members that aren't being factored into the loan. However, there is one common scenario where a high DTI loan can be sensible, which is when consolidating debt or doing a cash out refinance. By using the home equity to merge high interest debt, you can pay off your debts rather than making minimum payments. These types of debt consolidation loans have led borrowers to decrease their DTI from the 60s or 70s down to the 50s. Even though the debt to income ratio is still high, the overall household monthly budget can improve by hundreds of dollars each month.
Bonus tip, how to expedite your closing.
When you're preparing to purchase or refinance your home, do yourself a huge favor by getting your docs in order. Start a folder on your computer or smartphone just for the transaction. Gather up all your supporting docs, assets, ID, and insurance information. Take legible pictures and convert them to PDFs when you put them into the folder. There's many apps available to convert pictures to PDFs. Have everything organized and labeled so you're ready to go. Borrowers who are organized and who provide legible documents always close faster.
In summary, getting approved for a high debt to income ratio mortgage is possible in many scenarios. It's very important to work with a lender that's highly experienced with these types of loans. The best solutions for high DTI mortgage scenarios are FHA loan, VA loan, CDFI loan, and an asset-based mortgage. Find out which options would work for your scenario. You're welcome to reach out to me directly at balanceprocess.com. Please feel free to drop a comment below with any questions or comments that you might have. If this video was helpful, please give it a thumbs up and don't forget to subscribe. Thank you so much for your time and attention. We'll see you next time.